Welcome to another episode of The Brand Called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from hundreds of successful individuals from around the world. I am your host, Ashutosh Garg, and today I'm privileged and delighted to welcome a very, very dear friend, a fellow YPOer from New York, USA, Mr. Richard Katzman. Richard, welcome to the show.
Thank you, Ashutosh. Great to be here.
Thank you. Richard is the former chairman and CEO of CAS Inc. He's an investor in organizations, and he's an advisor to early stage companies. He's a board member of Forum Merger, and he's on the advisory board of Brown University Nelson Entrepreneurial Center. So, Richard, today let's talk about your wearing your hat as an investor. Let's start with, what is your investment philosophy and which industry groups do you focus on?
Well, initially I've been attracted to the space that I know best, which is consumer products.
Mm-hmm.
Although I've joined an investment group called New York Angels, which is one of the larger angel groups in the U.S.
Mm-hmm.
And we see a dozen or two companies every month, and they're from all over, all different kinds of industries and ideas. So my angel portfolio, and these are all relatively small investments and very early companies, but it's a pretty eclectic mix. But the companies I've invested a little bit more into have been mostly consumer businesses.
Okay.
So my first company, my first angel investment was a company called Canary, which made a kind of security webcam. And it's been a roller coaster ride with that one. And I guess that was sort of a precursor of angel investing in general, which has been interesting and fun, but also frustrating as well.
Well said. Well said. And when you said you look at 15, 20 investments every month, what are some of the key metrics you look for before you shortlist someone?
Well, with angel investments, you're coming in right after often a friends and family round, and there just really aren't that many metrics that you have. Some of the entrepreneurs are pretty young, but some of them are doing their second or third companies, and all of them have polished the 5-minute elevator pitch, and it's very slick, and there's lots of numbers up there, but they're when you do due diligence, it's still too early to have any measurements. We like to see companies with a little bit of traction, but a little bit of traction is sometimes 6 months of sales or a year going from zero. If you get from 0 to 100,000 in revenue, that's considered traction, and it's nothing really. So there's not a ton of things to measure, and also when you're making, even when we aggregate all of the people that are interested in that particular deal, it's still not a huge investment. So you're not doing the kind of, like when we both sold our businesses,
correct,
people come in and they do quality of earnings and they do full audited statements and everything. None of that exists with early companies. So generally it's the you look at the entrepreneur. Do they have a good record? Do you feel that they will be able to figure out all of the pitfalls that are going to for sure appear? And then the idea, is it a product that I can understand and do? And some of the businesses that I have no experience in, there's some fintech, there's some advertising and marketing that are getting into like measuring, helping people with social media and things that I have no experience in. I tend not to dig into as much.
Incredible. So it's basically a big leap of faith.
It's a big leap of faith, and one nice thing about investing with a group is you sort of have somebody in the group usually has some kind of relevant experience in that space, and so you lean on them a little bit. And when it's a company in my wheelhouse, then I've tried to
Wonderful.
Speak up.
Wonderful.
Yeah.
So I've often been asked this question, and I've asked this from many investors. Idea versus team. What excites you more?
Versus theme?
No, team of people.
Team. Good question. And it's funny. I would say the idea, excites me more, but I would invest more on the team than the idea.
Okay.
So, it's when I hear somebody who's come up with a very creative solution to a big enough problem, that's very exciting. And then you say, that's something I would buy myself, or I would, think is a pretty good idea. And then you hear them, and you start asking questions, and sometimes they have all the answers that they've thought it through, very carefully, and they've had experience, or they give you the impression that they're great problem solvers, and or they have a great track record. And so that's kind of the hurdle that the idea has to clear.
Very interesting. Another question that is often asked is that, from an investor perspective, do you like a sole founder, or do you prefer co-founders?
Well, I would be careful how I define like co-founder, because you can have 50-50 partners, or people, or you can have a great entrepreneur who has brought their team, built a team already that aren't necessarily they're co-founders, but they're not equal partners. And I think and my brother, who's been a successful entrepreneur, feels very strongly not to have not to do a business with partners, because it gets confusing, and
correct,
on leadership and on who's doing the most work or whatever. But building a strong team that has some equity and some skin in the game is essential. So I would we tend to shy away from businesses where it's just the one great personality and nothing behind them. And when they show not only they built a team that with complementary skills, but also they have people who are the early investors, or have an advisory board or a board. I think that has a lot of weight as well.
Amazing.
So
Amazing.
I think it's the team. And one other factor that whether it's idea or team is timing. I saw I guess it was a TED Talk or something where somebody who they did an analysis of thousands of startups and seeing which ones survived, and they measured how strong was the team, how strong was the idea, how big was the market, and then I forget, there was a fifth one, the timing. And it turned out like timing, which is really something you can't control that much. If you're too early or too late, you have a good chance of failure. So
amazing.
Like you couldn't do Uber before there was enough smartphones and people were comfortable with them to do it. So there were ride shares before that, and then once there's a dominant player, it's very hard to compete. So
correct. So that's an interesting segue to my next question. Based on what you mentioned, timing, etc. What, in your opinion, are some of the basic mistakes a lot of startup entrepreneurs make?
There's a couple that I've seen. One of the biggest pitfalls, I would say, is it's very hard not to get arrogant. There's so much money chasing deals all around the world right now, and so if you have an idea and you want to start a company, it's in the history of the planet, it's never been easier to do that.
Correct.
And then if you have any early traction at all, people really start chasing you, and I've had friends who are all distraught because they're oversubscribed and they don't know how to tell people. So when people are telling you how smart you are and how beautiful you are, and they want to throw money at you, it's hard not to start believing, that all those things. And that leads to not listening to advisors. It means it leads to thinking that you can spend money without any concern, because it'll keep flowing in. So if this doesn't work out, or you want to run a Super Bowl ad or something and blow it all there, that just open the faucet and refill the next day, and it doesn't work that way. So I've seen several cases where entrepreneurs just start believing their own nonsense sometimes.
On their own hype, isn't it?
Their own hype, and just fall right into a pit, and then they keep digging.
Absolutely right. I've come across many of the places where I've invested and got stuck for a very similar reason. So the next question, Richard, is that when you have private equity coming in, the pressure is always on the entrepreneur to scale up.
Right.
People are talking of Pan America or Pan India or Pan whichever country they're in. And I often say, but New York City alone has enough people. Why don't you just stay in New York City and then think of going up outside? My question is, at what stage should a startup start to scale up?
That's a great question, and it's one, and it's a great segue too, because that's exactly what happens is, they're telling you how great you are, and you have this great idea, so you want to share it with the world and and take it off. And I've seen it several times, and you've raised money, so you start spending the money, and your investors tell you they put pressure, as you said, they want to grow. And so and what happens is, before you've really proved concept, you've launched a multi-million-dollar marketing campaign, or you've hired 20 salespeople or whatever, or you get distribution in 6 national retailers, and plus Amazon and online, and you haven't filled your you haven't built your supply chain yet. So I'm pretty old school. I mean, we ran a company the company was like almost 90 years old when we sold it, and we were profitable pretty much every year, and we only raised money from private equity one time as a minority share. So we reinvested in the business, and it was a pretty conservative plan, but and I was proud, because over 25 years I averaged 16% year-over-year growth for 25 years. So we went from like 10 million to almost 500 million and $1 billion at retail.
That's big.
In today's world, that's not satisfactory growth. That would never be an angel investment. 16% growth,
Yes, you're right.
We had a lot of people working for us that had nice careers, and the company still exists, and it's doing great. So I don't, meanwhile, the 1600% growth, that's not sustainable. But to answer your question, I advise the companies to keep, especially with how easy it is to do social media advertising and online advertising, and you can run a $10,000 ad campaign and see real-time metrics as to how effective it is. And once you know that your cost of acquisition is less than your gross margin, then you can scale as fast as you want. You're going to be making money. But I've seen too many companies, and they'll spend all of it on unproven marketing and advertising because it looks good on. We've all been to conference room, and they put the pretty pictures, and this is your campaign, and they made mock-ups of everything. And say, yeah, that looks awesome. Do it.
And where's the money?
Maybe it's awesome, maybe it's not, but you can test it for very little money. And like one of the most successful entrepreneurs that I've ever known is Jay Walker, who founded Priceline, and he was running a magazine subscription business at one point, and he was saying, like, we're doing direct response, and we'll send 1,000 pieces out, and I know if it's 3.1 versus 3.2% response rate, then I know, then I can run 1 million pieces out. And he just tuned it in, and that's, I wish I'd see more entrepreneurs doing that, but the pressure is to go fast, and
well said.
I think Jack Welch had, or at GE, that was when GE was really rolling. It was like, I went to some of their training classes. I think YPO ran one once with them, and it was go slow to go fast was their mantra. And I think that's maybe like one of the better ones that young entrepreneurs or startups should adhere to. Go slow to go fast.
Very interesting. So now let me move to another segment, and I want to talk to you about Kaz. A company that I've seen you grow and build, and you had a successful exit. My first question to you is, what goes into building a powerful consumer durable brand?
So when I joined the business, it was third generation. So it was, and I really hadn't even planned on that being my career. My first job at the company was to put our first computer system in. I thought I was heading towards a tech career. And here it is that my grandfather invented this steam vaporizer, electric vaporizer, and they created the Kaz brand, and we had Kaz in all the pharmacies around the US. And there really wasn't new categories that the company was getting into. And Kaz was a good brand for pharmacists, knew who we were. And then if the pediatrician told the mom to get a vaporizer for the kid, they might say Kaz. But, we had maybe, a third of the market or so. So it was, so we were medium-sized fish in a small pond. And we were growing okay, but it wasn't it wasn't a true consumer brand.
Okay.
And then our friends at Procter and Gamble came in one day. I'd never, out of the blue, cold call. I got a call from someone said, Procter and Gamble wants to meet with you. The Vicks product manager wants to, and I thought, it's P&G, so I will of course take the meeting, but I didn't have very high hopes. And their concept, and it wasn't I wish it had been my idea, but it was their idea. And if it had been my idea, probably wouldn't have gotten anywhere with them. But it's always the best thing is always someone else's way to get to yes, is to have it be their idea. And they had this concept for licensing the Vicks brand on vaporizers, and it wasn't to get licensing revenue because it wasn't going to move the needle. At P&G, their concept was that all of the Vicks products, NyQuil, and NyQuil was their biggest product. They wanted to, when the more facings of product on the shelf, the more NyQuil got sold, but it was a small box. And they said, well, they did some studies on products, cough cold products, and vaporizers made sense because they had Vapo Steam and Vapo Rub, and here's a vaporizer. So we should do, but it's too small a category for P&G to get involved. So they said, well, we'll license it to somebody, and then when they get a big Vicks vaporizer display in the shelf, it's 10 times as much facings, but then they'll add some NyQuil to the display, and we'll sell more NyQuil that way.
Correct.
And they came to us, and we thought, like maybe private label we knew about, but they didn't want to do private label. They wanted us to sell it with their brand. And so cut to the chase, 10 months later, we were on shelf. We really, did the first licensing contract with P&G, really pioneered this kind of brand extension licensing, designed a new product, did the packaging, everything. And whereas before, to show you the power of that brand, it was we would struggle. We would make a presentation to a Walmart, whoever, and you're arguing or negotiating about maybe a nickel, on the price. And so it's like, and then when we presented this new Vicks vaporizer, no one even asked the price. They said, "Oh, of course, that's a great idea. We're to put it in." And so we thought if we did 100,000 pieces, that would be great. If we could have made 1.5 million, we would have sold every piece. And so to answer your question, that was a long answer to your question. There were, we went the licensing route, and later on we acquired the Honeywell consumer product line. And so leveraging in consumer, if you can create your own brand, that's awesome, but if you another route to take is licensing and leveraging off a brand that has equity with the consumer, that isn't in a category, that has what we call permission to go into that category. By the consumer says, yes, that makes sense. And so the next thing they asked us to do was a Vicks digital thermometer, which wasn't as obvious a brand extension. Right. And it turns out that, within every Vicks product we launched was instantly the #1 product in that category. Amazing. And then when I met you in India, I remember I was somewhere and we're talking to someone at some company, and they said like the second word that they learned after Mama was Vicks. It was such a powerful brand. And
it is.
You're right. It was Vic in India.
You're so right.
In some countries it wasn't, but mostly around the world it was a very powerful brand.
Absolutely.
And, so we rode that magic carpet to
fascinating.
Exponential growth.
Fascinating. Absolutely fascinating. So I've got time for one more question. Sure. And I'm going to blend this question between the bricks and mortar business of Kaz and your role as an investor now.
Okay.
How do you reconcile the fact that $1 billion company that you sold in terms of revenue had X valuation, and then along come these tech companies which are going into multiple unicorn valuations? As an investor, what do you think is the primary driver for such amazing valuations?
Well, on a personal level, obviously it goes between disbelief and intense pain, that we work so hard to have a profitable company. I mean, my brother has built 2 unicorns and that went public, and he's well on his way on his 3rd company. Wow. And I don't believe he's had a profitable quarter more than once or twice in 30 years. And so I will confess to not understand some of the math behind some of these things. I mean, obviously interest rates have something to do with it, but like we sold to a strategic acquirer, but we had private equity money. Even I forget what the multiple was, but I think we had a very healthy multiple, on our exit at the time on EBITDA. Okay. Right. Now there's typically a company like ours is going for 2 to 3 turns more. So that would have been maybe 30-40% more if we'd sold today with the same story. Yeah. But these companies are going for multiples of forward revenue, which and some of them like Uber still is not close to profitable. WeWork is may never be profitable. Yeah.
That's a different story altogether.
So I don't. To answer your question, okay, you got me.
I got that. But I must mention this to you that I was talking to a couple of unicorn founders, and I asked them the same question, and they gave me a very simple answer. They said it needs rare talent to lose money and get valuation. So I said, well, that says it all then.
Well, that's the P.T. Barnum mantra. Right?
Absolutely.
So, yeah.
Absolutely.
I mean, I guess, the investment thesis is, when you have a dominant brand, then you can raise prices and cut back your marketing and you'll be profitable. But some of these businesses are so far from having a chance to do that, and and those competitors are, the barriers to entry, because the tech is so good and so easy to put things together at this point. It's very hard to have a technology fence around your product.
Fascinating.
So,
fascinating. Richard, on that note, thank you very much. It's been such a pleasure speaking to you. Thank you for talking to me about your investment philosophy, talking to me about the incredible organization that you built and then exited, CAS. Thank you for talking to me about your experience on Wix and P&G. And good luck on whatever you're investing in, because I hope there'll be many, many unicorns in your portfolio. And I look forward to catching up with you soon in New York.
Okay, well, one would be good. I look forward to seeing you, and it's great catching up.
Yeah.
So,
thank you.
Take care.
Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.